Lily, did you hear what the new Fed chairman Kevin Warsh said just 2 days after being sworn in?
He just took office on May 22nd, right? What did he say?
He said inflation is quite favorable and close to the Fed's 2% target. But when I walk into the grocery store, eggs are still $6 a dozen, gas is $4.55 a gallon, and California is paying over $6 at the pump. How is that quite favorable?
That's exactly what I'm feeling. My friends are all complaining about prices, but the Fed is saying inflation is under control. Something doesn't add up.
What doesn't add up is that Warsh isn't looking at the same inflation number you and I feel. During his Senate confirmation hearing in April, he said the Fed should stop using the traditional core PCE measure and switch to something called trimmed mean PCE.
Trimmed mean? What's that?
It's a statistical method that throws out the most extreme price, changes both the biggest increases and the biggest decreases, and only looks at the middle. The Dallas Fed tracks this measure, and right now, it reads 2.3%. Meanwhile, the core PCE that the Fed has been using for decades reads 3%. Same economy, different measurement, and suddenly, inflation looks a lot better.
So he's changing the ruler to make the problem look smaller.
That's one way to put it. And here's why it matters. America's national debt just hit $39 trillion in March. That's over 120% of GDP, the highest since World War II. Interest payments alone are now over $1 trillion a year. And here's the kicker. $10 trillion in treasury debt is rolling over this year alone, meaning the government has to refinance it.
10 trillion in 1 year. That's insane. How do they pay for that?
That's where Warsh's plan comes in. If he can declare that inflation is already near the 2% target using his preferred trimmed mean measure, he can justify cutting interest rates. Lower rates mean the government can issue new short-term debt at cheaper rates. With 10 trillion rolling over, even a half-point rate cut saves tens of billions in interest payments. It's a short-term band-aid.
But you said short-term. What about the long-term?
The long-term solution is even more devious, and it affects all $39 trillion of debt. Let me give you an analogy. Imagine you want to buy a computer monitor that costs $100. You borrow the money from a friend and promise to pay back $102 in 1 year. That's 2% interest. A year later, you hand your friend $102. But during that year, inflation pushed the monitor's price up to $120.
So my friend got back $102, but that money can't buy what it could have bought a year ago.
Exactly. In real terms, your friend lost purchasing power. You, on the other hand, still have the monitor, and it's now worth $120, but you only paid $102 for it. Now, replace you with the US government, and your friend with every investor who bought a US Treasury bond. Instead of $100, it's $39 trillion. If Warsh manages to keep interest rates below actual inflation, the government gets to pay back expensive dollars with cheap ones.
That's a hidden default. They're not refusing to pay, but the money they're paying back is worth less.
Proverbs 11:1 says, "Dishonest scales are an abomination to the Lord, but a just weight is his delight." What is a dishonest scale? It's when you deliberately choose a measurement method that understates the problem, then declare victory. Warsh is choosing trimmed mean PCE because it gives the lowest inflation reading, not because it's the most accurate.
But didn't you say this measure has problems?
Huge problems. Bank of America economist Aditya Bahav warned that the trimmed mean measure has a downward bias. From 2021 to 2023, when inflation was surging, the trimmed mean consistently underestimated it. It was the slowest to register the inflation spike. Critics say if you use this measure now, you're essentially flying blind into the next inflation wave.
So what happens if he's wrong? What if he cuts rates based on the trimmed mean reading, but actual inflation keeps rising?
That's when the scheme backfires. When consumers see rent, food, and transportation costs continuing to rise while the Fed declares victory on inflation, people raise their inflation expectations. Workers demand higher wages. Businesses raise prices ahead of cost increases. Landlords build in bigger rent hikes. Those expectations become self-fulfilling, leading to higher sustained inflation. And once that spiral starts, it's extremely hard to stop.
This reminds me of what we talked about in episode 200, the bond market taking back pricing power from the Fed.
Exactly. And that's already happening. Since September 2024, the Fed has cut rates 6 times. Over that exact same period, the 10-year Treasury yield went up, not down. Just this week, the 30-year Treasury yield hit 5.13%, the highest since 2007. Bond markets are already pricing in their own view of where inflation is headed, and they're not buying the Fed's story.
So even if Warsh cuts the Fed funds rate, long-term rates could keep rising?
Precisely, and that creates a nightmare scenario for first-time homebuyers. Mortgage rates are tied to the 10-year Treasury yield, not the Fed funds rate. So even if Warsh cuts short-term rates to help the government refinance its debt cheaply, mortgage rates could stay high, or even go higher, because the bond market doesn't trust the inflation narrative.
That's brutal. So existing homeowners with fixed-rate mortgages benefit because they're paying with devalued dollars, but first-time buyers get locked out?
That's the K-shaped economy in action again. Those who already own assets, homes, stocks, gold, benefit from inflation eroding their fixed debts, but those trying to enter the asset-owning class face higher barriers. It's the Cantillon effect all over again. Those closest to the money printer get the advantage.
And savers get crushed.
Absolutely. When short-term rates fall, banks pay less on savings accounts. If true inflation outpaces the interest those accounts earn, savers lose purchasing power every single day. Retirees living on fixed income? They're getting silently robbed.
So who actually benefits from Warsh's plan?
The US government benefits by eroding $39 trillion of debt through inflation. Large corporations benefit because they can borrow at low rates and buy assets. Wealthy individuals with fixed-rate debt and appreciating assets benefit. But the working class, savers, first-time homebuyers, and retirees all bear the cost.
This sounds like a massive wealth transfer disguised as monetary policy.
That's exactly what it is. Austrian economist Ludwig von Mises warned about this over 100 years ago. When central banks print money and manipulate interest rates, it doesn't benefit everyone equally. The first recipients of new money banks, government, large corporations, get to spend it before prices rise. By the time that money trickles down to workers and savers, prices have already adjusted upward. It's not a bug, it's a feature.
Corey, what should people do about this? How do we protect ourselves?
First, understand that allocating physical gold and silver isn't about short-term profits. It's about ensuring that during future turmoil, your family's wealth and purchasing power won't be diluted by fiat currency. Right now, gold is around $4,744 per ounce. Silver around $76. Are these prices high? From a historical perspective, yes. But the question isn't whether prices are high or low. The question is, when the stock market corrects 50%, when fiat currency purchasing power is deliberately eroded, what protects your wealth?
Physical gold and silver.
Right. Because if you can't touch it, you don't truly own it. Stocks can be delisted. Companies can go bankrupt, banks can fail, governments can default. Even Treasury inflation-protected securities tips are only as good as the government's willingness to accurately report inflation. If they're changing the inflation measurement method itself, how much can you trust a tips bond adjusted by that same rigged number?
So tips are still paper promises.
Exactly. The only asset in your hands, in your home, not controlled by any system, is physical gold and silver. This is why Chinese and Indian people have been accumulating physical gold and silver for thousands of years. They deeply understand that only assets you can hold in your hands are true wealth.
Haggai 2-8 says, "The silver is mine, and the gold is mine, declares the Lord." When 39 trillion in debt has no exit, when government's only solution is letting inflation erode that debt, the only wealth that won't be diluted is the currency God created.
And here's something critical to understand. You need to act before the crisis hits. During the 2008 financial crisis, when people wanted to buy physical gold and silver, dealers were sold out for months. And the premiums were 3 to 5 times normal levels. Right now, you can still buy at relatively normal premiums. The market is still functioning. That's a window of opportunity.
So don't wait until gas hits $10 a gallon and everyone's panicking.
Right. Build your wealth emergency kit now. Layer 1, physical gold and silver for wealth preservation. Layer 2, defensive cash to cover 3 to 6 months of basic expenses. Gold is better for large savings. Silver's smaller unit value makes it suitable as backup for daily transactions. Hold both together.
What about the timeline? When does this scheme play out?
Warsh takes over a Federal Reserve that's more divided than any time since 1992. The last Federal Open Market Committee vote had 4 dissenters going in 2 different directions. Jerome Powell is staying on the Board of Governors, extremely unusual for an outgoing chairman, presumably to safeguard the institution from political pressure. Warsh said he welcomes a good family fight, which means he expects pushback. This isn't going to be smooth.
So, even if he wants to implement this trimmed mean framework, he might face resistance?
Yes, but the bigger constraint is reality itself. Bond markets are already revolting. The UK 10-year gilt yield hit its highest level since July 2008. Japan's 30-year yield hit a record. The US 30-year at 5.13%. These are global investors saying, "We don't trust your inflation narrative." When bond markets reject central bank policy, the central bank doesn't have unlimited power anymore.
That's the ultimate signal David Morgan talked about in episode 200, when the Fed cuts rates, but bond markets push yields higher anyway.
Exactly. That's when you know the game is over. The market has taken back pricing power. And when that happens, all the trimmed mean measurements in the world won't matter. Reality has a way of asserting itself.
So what's the bottom line for our listeners?
The bottom line is this. Kevin Warsh's regime change at the Fed isn't about fixing inflation. It's about creating the statistical cover to cut rates while maintaining the illusion of price stability. The real goal is to help the US government erode $39 trillion of debt through negative real interest rates. This is a wealth transfer from savers, workers, and bondholders to the government and asset owners. If you want to protect your family's purchasing power, you need to hold assets that can't be manipulated by statistical tricks. Physical gold and silver are the only money that can't lie.
Proverbs 20:23 says, "Unequal weights are an abomination to the Lord, and false scales are not good." Changing the scale doesn't change the reality. It just hides it for a while.
And when the hiding ends, those who prepared will survive. Those who trusted paper promises will learn a very expensive lesson. We plan, God provides. Don't wait for the crisis to prepare for the crisis. See you next time.
See you.